Hey there, friend. A quick question. If you were to die tomorrow, would your family's lifestyle disappear with you? This is a tough question, I know. But stay with me. A man once asked me, how do I create wealth that my grandkids can't destroy? My first answer? Start with life insurance. And today, I'm going to show you, step by step, why that's the smartest foundation for generational wealth, and how to design it so that even a reckless grandchild can't burn it to the ground. By the end, you'll know why generational wealth fails, why life insurance is the foundation of wealth, what type of life cover to choose, how to size the sum assured, how to use trusts so money lasts for decades, not months, and the exact do and don'ts wealthy families use to keep fortunes intact. Let's go. Topic 1. Why generational wealth fails. You've heard the saying, shirt sleeves to shirt sleeves in 3 generations, where the first generation builds wealth, the second generation enjoys it, and the third generation destroys. Wealth advisors cite that around 70% of families lose wealth by the second generation and about 90% by the third. It's an old adage, but the pattern is real enough that top advisors plan against it. So, why does it happen? There are several reasons. Reason number 1, no liquidity when death happens. Most families build wealth in fixed assets, land, business shares, rental houses, vehicles, farm equipment, even livestock herds. On paper, this looks impressive. You can point to property, show titles, or boast about the number of cows you own. But here's the problem. These assets are not liquid. You can't slice a plot of land to pay hospital bills tomorrow, or sell one rental unit overnight to cover next term's school fees. What about shares in a private company? They take months or years to transfer, and only if a buyer can be found. Even cars and livestock, though movable, fetch far lower prices when you're under pressure. So while the family looks asset-rich, in reality they are cash poor when crisis strikes. And in that desperation, they end up panic selling, disposing land or businesses at throwaway prices just to get quick cash. The buyer dictates terms, the family loses long-term value, and the wealth the breadwinner spent a lifetime building is eroded in months. Reason number 2, lump sum temptation. A single massive cash transfer with no guardrails almost always ends the same way. Flashy cars in the driveway, rushed business ventures, and that one friend promising to double the money in 6 months. Within a few years, the fortune is gone, not because the family lacked money, but because they lacked structure and governance. Reason number 3, probate delays. In Kenya, when someone passes away, the grant of representation, that's probate or letters of administration, often takes 6 months or more. And if there's a family dispute, it can stretch well past a year. During that entire time, the estate is legally frozen. The land, the rentals, even the bank accounts can't be touched until the courts release them. If there's no liquidity, no ready cash, the family suffers in the meantime. School fees go unpaid, medical bills pile up, and daily living grinds to a halt while the estate crawls through the legal system. Reason number 4, no rules, no governance. Too often, the inheritance lands straight in the hands of the least prepared heir. There's no investment policy, no milestones, no trusted gatekeeper to guide decisions. Overnight, A young or inexperienced beneficiary is sitting on millions without the maturity or financial literacy to manage it. The result? Impulse spending, risky ventures, and wealth that took decades to build evaporates in just a few short years. So, how do you fix this? These challenges highlight the need for a solution that combines immediate liquidity with structured control, and that's exactly where life insurance comes in. Next, we'll explain why life insurance is the ideal tool to preserve wealth, provide instant cash, and protect your family from these common pitfalls. Topic 2. Why life insurance is the foundation of wealth creation. Let's be real, most people don't keep their wealth in cash. Here in Kenya, wealth are always in form of a piece of land, a few rental units, or maybe shares in a family business. But here's the problem. When the breadwinner dies, those assets don't instantly translate into cash to sort school fees or hospital bills. And here's why life insurance really stands out in plain terms. First, it's the only asset that pays out its full value exactly when it's needed most, the day you pass away. Second, the money goes straight to the person or people you've named as beneficiaries, usually without long court battles or probate delays. It's simple, direct, and designed to protect your family right when they need it most. Example: imagine a father in Nairobi. On paper, he's worth 15 million Kenya shillings in land. But when he passes away, his wife can't carve off half an acre tomorrow to pay for their children's school fees. Because even if she wants to sell, buyers drag their feet. And lawyers might also get involved. The family ends up selling quickly, often at half the real value, or incur further costs in litigation. Now compare that to if he had a 20 million shillings life policy, in which he named his wife the beneficiary. Within weeks, the money hits the family's account. And with that, school fees paid, debts cleared, the family piece of land preserved, waiting for the right buyer at the right price. That's liquidity. That's peace. And here in Kenya, the government even sweetens the deal. Through insurance relief, you get 15% off your premiums, up to 60,000 Kenya shillings a year. That's up to 9,000 Kenya shillings shaved off your tax bill every year, simply for protecting your family. Think of it this way. The government is literally rewarding you for being responsible. Now, people ask me all the time, but won't the government tax the payout? In most countries, including Kenya, death benefits from life insurance are tax-free to beneficiaries. That's the beauty of it. The only thing that might be taxed is interest earned after the payout if it sits in an account. But the core lump sum, the life cover itself, goes straight to your family tax-free. Always double-check with a tax advisor, but that's the standard. So here's the bottom line. Life insurance is not just another financial product. It's the foundation. It gives your family cash fast, when courts are slow, when land buyers are slow, when banks are slow. It is the difference between a widow begging relatives and a widow confidently keeping her children in school. It is the difference between a business collapsing and a business being passed to the next generation intact. Local or global, rich or poor, the principle is the same. If you want wealth your grandchildren can't destroy, you must first make sure that wealth survives you. And the only tool designed for that moment is life insurance. Topic 3. Choosing the right policy, for generational wealth creation. When it comes to protecting your family and building generational wealth, not all life insurance policies are created equal. The key is to match the type of policy to your goals, obligations, and stage of life. So, what type of life cover should one purchase? Policy number 1. Term life insurance. Term life is straightforward. It provides cover for a set period, say 10, 20, or 30 years. This is ideal when your responsibilities are highest, young children to educate, a mortgage to pay, or significant debts on your shoulders. Term policies give you maximum cover per shilling, making it an efficient way to safeguard your family during your highest risk years. For long-term planning, some people use laddering, stacking multiple term policies of different durations. For example, a 10-year term for short-term obligations and a 20-year term for longer responsibilities. This ensures coverage gradually reduces as debts are cleared and children grow independent, optimizing cost without leaving gaps. Policy number 2. Whole life insurance. Whole life provides cover for your entire life, as long as premiums are paid. While more expensive than term, the value lies in certainty. This type of policy guarantees a payout, which is extremely useful for estate planning and ensuring liquidity to settle taxes, debts, or other obligations whenever death occurs. For families looking to leave a lasting legacy, a whole-of-life policy ensures the money is there to preserve assets, land, businesses, or investments, without forcing heirs to sell under pressure. Policy number 3. Endowment and education policies. These are hybrids of insurance and savings, maturing at predetermined dates. They are particularly helpful for parents who want forced discipline in wealth accumulation, such as funding children's education or a planned inheritance. By setting clear maturity dates, endowment policies can ensure cash is available for major life milestones without the family having to liquidate assets prematurely. This way, wealth preservation and liquidity go hand in hand, reducing the risk of panic sales or financial mismanagement. Policy number 4. Investment-linked policies, ULIPs. These policies combine life cover with market-linked investments. They allow policyholders to benefit from potential market growth while maintaining insurance protection. However, they come with higher complexity, charges, and market risk. For generational wealth planning, ULIPs can be useful if the family has a longer horizon and the ability to tolerate market fluctuations, providing both growth and protection. The key is understanding costs, lock-in periods, and investment strategy before committing. Policy number 5. Business-focused coverage. For business owners, policies like key person insurance are essential. These policies protect the company if a founder, rainmaker, or crucial employee passes away. The payout can safeguard jobs, maintain supplier relationships, and ensure loan covenants are met. In effect, this protects the business, a key family asset, and prevents wealth destruction that often happens when a family-run business suddenly faces financial stress after losing a critical leader. Now that we know which policies to purchase, the next question is, how much cover? A simple field formula helps. Take 10 to 15 times your annual family spending, add debts, education, and a legacy cushion, then subtract any liquid assets you already have. This ensures your policy aligns with real financial needs, not just assumptions. And remember, The right premium is one you can sustain for decades because the protection only works if it remains in force. Applicable policy riders. Lastly, let's run through riders that you need to consider. Riders can enhance your policy and strengthen generational wealth protection. Rider number 1. Waiver of premium. This rider keeps your policy active if you become disabled, so your family is never left unprotected. Rider number 2. Accidental death benefit. This rider provides extra security for unexpected events. Rider number 3. Critical illness cover. This pays a lump sum if diagnosed with serious illness, protecting your wealth plan while you're still alive. In summary, the right life insurance policy, whether term, whole, endowment, investment-linked, or business-focused, serves as the backbone for building and preserving generational wealth. It ensures liquidity when needed, structured payouts for heirs, and protection for family assets, so wealth doesn't vanish with the first emergency or inheritance misstep. Topic 4. How to make wealth indestructible using a trust. Now, let's talk about making wealth indestructible. You can have all the right policies, but without rules, it's fragile. The tool that makes your family's money last across generations? A trust. Here is how to go about it. Step 1. Name a trust as beneficiary. Instead of handing an 18-year-old a huge lump sum from a life policy, which they might burn through in months, you let the policy pay into a trust. The trustees then manage and release money according to rules you set. These rules can stipulate 1. Education fees paid directly to schools. 2. Health expenses as needed. 3. A first home deposit. 4. Business startup capital. 5. Age-based milestones. Say, X Kenya shillings at 25, more at 30, more at 35. This is exactly how wealthy families preserve capital for decades, even centuries. In the UK and US, writing life policies in trust is standard. Money stays out of probate and, where applicable, inheritance taxes. In Kenya, while the tax angle differs, the control and continuity benefits are just as powerful. Step 2. Choose the right trust and trustees. Kenya recognizes trusts under laws like the Trustees, Perpetual Succession Act, and the Trustee Act. Trust deeds are formal, registered documents outlining powers, duties, and how assets are managed. You can appoint corporate trustees for professionalism and continuity, or family trustees to ensure your intentions are followed. Pair your trust with a valid will under the Law of Succession Act. This maps everything else you own, land, shares, business, bank accounts, and avoids disputes. A trust plus a will is the ultimate safety net for your legacy. Step 3. Define distribution rules. Here are rules you can literally lift into your deed. Education first. Pay schools directly. Needs test allowances. Monthly stipends that adjust based on actual needs. Milestone grants. X Kenya shillings for a first home, but only if the beneficiary saves 10% themselves. Entrepreneurship vetting. Release capital only after a business plan is approved by a small committee. No-go rules. No loans for sports betting, forex schemes, or luxury cars before 30. These rules keep money productive, safe, and aligned with your values. Step 4. Investment policy. A simple investment policy statement ensures trustees don't rely on gut feelings. It defines target asset mix, risk limits, rebalancing schedules, and spending rules, e.g., distribute up to 3 to 4% of trust value per year unless school or health needs demand more. This way, the trust grows consistently and responsibly, and payouts are predictable. Step 5. Keep payouts out of probate. One of the biggest headaches in Kenya is probate delays. Grants of representation can take 6 months, letters of administration up to a year, and longer if disputes arise. By naming a trust or an assigned beneficiary, life policy payouts bypass probate, giving your family immediate access to cash while the estate is processed. No panic selling assets, no family stress, just smooth continuity. So, a trust is more than a legal structure. Paired with the right life insurance policy, it turns your wealth into an enduring legacy, protected, governed, and growing for decades to come. Topic 5. Relatable case studies. Case 1. A family spends 180,000 Kenya shillings per month. Their mortgage balance 10 million Kenya shillings, and they have 2 kids, 7 and 3. They buy a 20-year term life policy valued for 30 million to cover spending plus mortgage plus education cushion. They also buy a small whole of life policy valued at 5 million Kenya shillings for permanent liquidity for later estate costs. They set the beneficiary as family trust. They set the following rules. 1. Schooling first. 2. Basic stipend until age 22. 3. Seed capital for a first home at 28 with 10% personal savings. 4. Business funds only after plan approval. Why it works. If the breadwinner dies next year, there's immediate cash. The home isn't fire sold. Kids stay in school. Future choices are governed by rules, not emotions. Case 2. SME owner. He owns a fabrication company employing 32 people. He's the chief dealmaker. He buys key person cover for 20 million Kenya shillings payable to the company plus personal life cover paying to a buy-sell agreement trust so co-owners can buy his shares from the family at a fair price. Why it works. The business survives the shock. Employees keep jobs, and the family receives value without being forced to run a company they don't understand. Case 3. The diaspora caregiver. A Kenyan nurse in Qatar supports parents and younger siblings. She sets a whole-of-life policy with beneficiary as education trust for nieces/nephews with rules. Tuition only, audited annually, and used funds reinvested. Why it works. Money goes to education only, not to lifestyle creep. Case 4. The Chama with vision. A Chama buys small life covers on each member naming the Chama trust as beneficiary, with consent and proper structure. Proceeds top up a perpetual education bursary for members' children. Why it works. One death doesn't derail contributions. It cements the legacy. You put guaranteed liquidity and clear rules in place before anything happens. Liquidity through life insurance makes sure the family has cash on day one. Rules, through structures like trusts or beneficiary guidelines, make sure that money lasts, grows, and serves its true purpose. That combination is how you prevent wealth from being destroyed and instead turn it into a legacy. That's why life insurance is so powerful in this context. It converts risk into immediate liquidity. While fixed assets take time to sell, insurance delivers cash instantly, covering urgent needs while preserving the bigger assets for thoughtful, fair value decisions later. If you truly want wealth your grandchildren can't destroy, do these 2 things this month. Buy the right life cover you can afford long-term. Route it into a trust with rules that outlive you. Protect first, then grow. I'm cheering for your family. If this video provided you with value, hit the like button and share it with a friend, a colleague, or a family member. Remember to subscribe to our channel and activate the notification bell. Questions, comments, or contributions? Hit on the comment section. We would love to hear from you, even if it is a simple thank you or correct this or that. In our next video on this series, we will review some case studies as well as how to combine trusts, policies, and investment strategies for maximum multi-generational impact.
See you then.